Today, I'd like to talk about the First Brands bankruptcy that started a few days ago and try to go through why is it going bankrupt and why we continue to do the same things over and over again. And that's the use of what we call SPEs, special purpose entities, SIVs, special investment vehicles. So let's go back. The first company that really came out that used SIVs, special investment vehicles, was a little company called Enron, okay? Then for the great financial crash, all our big banks, every one of them, the CEOs should have gone to jail because they opened up all these SIVs, special investment vehicles. They borrowed money from it and then gave it to the bank, okay, the big bank. But they're in these other legal entities. You say, what's the problem? Here's the problem. The banks never declared the debt in the SIVs as their debt. They owned the SIV 100%. But they said, well, it's not ours, it's over there at SIV. But when the SIVs went belly up, the banks had to pay for it, and that was one of the biggest things that caused the crash of 2007. But no one ever talks about that. So now we have First Brands is going belly up. And it starts here on September 19th. They say, whoa, look at this. There's more than $1 billion worth of paper losses, and it's expected to be a messy restructuring. And the reason the losses were there, the senior loans, I want you to remember, there's levels in the debt structure. Senior loans, mezzanine loans, junior loan, sub-junior loan. What they're saying here is the senior loans are at 45 cents on the dollar, which is bad, okay? And then the junior is trading between 16 and 21 cents on the dollar, okay? And they're saying that it's very chaotic. Everyone's trying to figure out what's going on and how could this company deteriorate so fast. So now 3 days later, First Brand lenders race to rescue the car part suppliers as the debt woes rattle the market. So kind of the basic facts here. They borrowed $6 billion, okay? So the regular company goes out and you have to pay the interest on the $6 billion. But they also have more in financing facility linked to customer and supplier invoices. And what does that mean? So when you're a big company, you have a lot of inventory, people borrow against their inventory. Then they sell the parts, they bring back the cash, and they pay it off, okay? Unfortunately, this financial engineering has been used many times to, let's call it, double or triple dip on the assets that you're borrowing against. And they say that it looks like it's going to be over $4 billion that is underpinned by both the money that customers owe First Brands and borrowing back by its inventory, okay? Now, they are trying to raise $6 billion, probably to pay off the $6 billion that's coming due, okay? But they had to hire Deloitte to come in on quality of earning. But what happened, everything fell apart, and now the refinancing is totally off the table. And then look down here, in the second to the last paragraph here, the U.S. private equity group was joining the trade with hedge fund Diameter Capital Partners, which owns the stake. Both groups recently closed a position, said people familiar with the matter. The market's trying to come to grips with the size of the financing linked to First Brand's invoices. Again, how many times did First Brand borrow against their inventory? Now the banker for First Brands is Jefferies. But guess what? They also have exposure to these invoice-linked facilities because they're the ones who set it all up. And Jefferies has deep ties to First Brands, which also led to a planned refinancing deal that was halted in August. So what they're saying, that $6 billion refinancing was being led by Jefferies, okay? So First Brand recently told lenders it has more than $800 million of cash at the end of June, but they're due $6 billion this year. That's why they tried to raise the money. So in companies like this, what you try to do in your financial engineering is we have all the debt levels, we talked about that, senior, junior, mezzanine, whatever. What they do is they try to push them down one or two pegs on the thing, and they issue a new senior debt, okay? And this new senior debt now gets paid before all the other debt, but the other debt signs off on it because they're not going into bankruptcy for this. But when you look, they can't actually come to this, it is very unclear how the company could create a new tier senior debt, because usually that senior debt is based upon assets of the firm, and we all know that looks like we have multiple times they borrowed against their inventory. So what are we looking at here? So you got First Brands, who are controlled by Patrick James. Patrick James goes out and opens up 5 SPEs. All these 5 SPEs borrow money against the inventories of First Brand, and then give the money to First Brands, okay? We think, we're not sure of that. So then you say, and all 4 of the 5 of Patrick James have all filed for bankruptcy 1 or 2 days after First Brands filed, okay? So here in the first line is the bad news, okay? Carnaby bankruptcy filing says, hey, we have estimated liability between 1 and 10 billion. They're estimating between 1 and 10 billion, amazing. With assets of 500 million to $1 billion. You know it's 500 million, okay? And they also see in the bankruptcy that the 5 SPEs cross ownership of each other, okay? So not only do they own First Brand, they own each other, all right? So how much money can you get paid for this stuff? So another issue that this bankruptcy is facing is, look at this AB CarVal's Credit Opportunities Fund showed at the end of the year it owned a few millions of short-dated facilities for both First Brands and Carnaby, basically the same company, all right? The footnotes show they are level 3 assets. Remember our videos on level 1, level 2, level 3. Level 3 is they can't be priced, okay? And the company themselves, i.e. AB CarVal, determines the fair value. Great position. So in the third paragraph here, First Brands made liberal use of invoice factoring. That's what we're talking about. Multiple times they promise their inventory against debt, okay? And they tell it, this is what Greensill did, which collapsed, which it was a couple European banks that went down. And in our jargon, we call this working capital finance. The question is, how much money can you earn on this? Well, in these bankruptcy filings, we find out they're getting 14% over the 3-month SOFR. Well, the SOFR is like 4.5. That's 18.5%, 19%. So in other words, the guy owns First Brand. He owns the 5 SPEs. The SPEs get the money from First Brand and charge them 19%. Same company, same guy paying himself 19%. But they were just warming up with that. So when you go through all these guys who declared bankruptcy, guess what they say? The coupon rates listed are as high as 50%. 50%, okay? Even though the guy says, hey, this is not a true interest rate. So it appears it's a calculation to the all-in return Keystone is looking to book on these deals rather than the headline interest. Again, we don't know. We're going to find out. And here you can see the headlines on the 25th. All the entities linked to First Brand file for bankruptcy protection. So what does this mean? This is what it means, okay? That we have been going since Enron, the first use of SIVs. Our banks used them for the 2007 crisis, okay? And here we are back again with literally the first big bankruptcy in a few years, right? Greensill and Huang went, right? And so here's the deal. We don't know how far this goes. Is this going to affect Jeffries? Is this going to affect all the private credit funds? All these questions are going to be answered, and it doesn't look like, given the structure of the firm and given what we know already could be advanced financial engineering, i.e. fraud, they can't do a senior refinancing. So What do you think? Should we get rid of SPEs or what? Like and follow and tell me in the comments.